oil. Commodity prices are plunging. Oil, in fact, down by the most in 2 days, down 15% this week so far. Cotton, coffee, wheat, all down. Silver has lost nearly 1/4 of its value in the past 4 sessions. Now, some money managers say it is a classic liquidation move in a crowded trade. Nick Moore is with us now. He's the chief commodities strategist at RBS Global Banking and Markets. He's with us from London. Nick, is this selling across all commodity types panic selling, or are these moves just a natural trading correction?
Oh, thank you, Deirdre. I think the phrase that springs to mind is rough winds do blow the darling buds of May. This is meant to be the merry month of May, and it's in a strange echo. We had this last year when we had a 20 to 35% decline in commodity prices ahead of the seasonal weaker demand period. Part of the issue for commodities is that it's a crowded trade. Algorithms are increasingly driving these trades so that you have strong upward moves and strong downward moves. So I don't think it's panic. My message to people will be keep calm and carry on. This is a very healthy washout, and actually I was warning earlier this year. I did a commodity companion with the RBS clients entitled Pump Up the Volume, that the next logical stage was actually more about volume than about pricing. Well, so I'm not too concerned about this.
Speaking about volume, I mean, the global appetite for natural resources is not going to change, right? So is that part of the idea that prices will eventually stabilize and then maybe even be in line with demand?
Absolutely. I mean, demand last year was superb. Aluminium, the best in generations, up 20%, nickel 19%, copper 12%. So actually there's nothing wrong with the demand story. And this is also, as though some of the triggers yesterday were US data related. It is actually more China we have to focus on. That's the accounts for sort of 35–40% of world demand. So any slowing in China has caused nerves. But there wasn't any real trigger yesterday. I think this is actually just an overextended trade, and that the markets, you have to look. I'm a fundamentalist. And as an analyst, I became increasingly uncomfortable with the higher commodity prices.
It sounds like you feel like it was a very frothy trade to begin with. And Nick, I'm just curious, I mean, if you had to pick one product that was divorced from reality, would you pick silver, or is there another one out there?
Yeah, supersonic silver, more froth than a cappuccino. When you look at these, I mean, the GFMS, the consultants, estimated that total world costs of producing silver about $5.27, and yet you could sell it for nearly $50. I mean, the margins were massive. So always you've got to keep an eye on the fundamentals. You've also got to see that there's an overhang. Silver has a significant overhang held now in physically backed ETFs, which has to be absorbed by the investors. So yes, I think silver is probably the cheerleader. But remember, nickel was one back in 2007. The price went up to over $50,000 a tonne. It's now half that. So this is the very charm and nature of commodities. Great bang for your buck, but you've got to be fleet of foot. This is not for the naive investor.
Nick, what is the right price then, before we let you go, for oil, for silver, and for gold?
I think for silver, between $25 and $30 an ounce would be a fair reflection. We're currently at 35, and I look at various pair trades to get an idea of where we are. I think certainly oil, we've got a surge in Iraqi oil on its way. I think it's good news for people that the oil price is lower. I mean, let's think of the good news here. Consumers, raw material prices are lower. That's good news for those. It's good news for inflation watchers, and it's also good news for price-induced demand destruction. So when you think what's the right price, you know, for example, 10,200 for copper was too high, 4 times the price of aluminium. It caused price-induced demand destruction and substitution. So I think oil, I would think 90 to 100 is actually a fairer range for the oil price, given our expectations of fresh supply. And I think for gold, remember in January we were down at 1310. We've been up to 1575. We're now midway. I think for oil, somewhere between 1350 to 1400 for gold, sorry, is a good clearing price. That would be my favoured price. And I expect some of the central banks should really right now be looking at harmonising their reserves and selling into this price before it's too late.
Nick, we thank you so much for the time, for your insight. Nick Moore joining us there. He is head of commodity strategy at RBS, joining us there from London.